Hello and welcome to week 1, lecture number 2 of financial reporting for small business. We're going to move into the financial statements, and a lot of this will be review, but again, it's a focus on small business, so it might be some new things here. Okay, as you may or may not know, financial statements are the formal reports of an entity's financial information. Can be used to show how the business is performing and where it stands, and from there we develop all sorts of other ideas as well. Okay, so the financial statements are the main source of information. There's summary of all the entries, and by themselves, journal entries and ledger entries aren't going to make much help to you. But if we have a look at the financial statements, when we figure out what the company's up to and help us make some more decisions about the company, whether they be financial management or operating, whatever the case may be. You have to understand the financial statements if you want to be in business. So far, you've made financial statements. Now, in this course, we're going to try and get you to understand what they do, which is a little bit more of a esoteric sort of thing. Okay, so financial statements, whether they're done weekly, monthly, daily, annually, help us understand what the business is up to. We got to make a profit, so that's the income statement. Got to generate some cash flow from these profits, and that'll help us with, or the cash flow statement will help us with that. And our financial condition and solvency, i.e. the business owns more than it owes, comes from the balance sheet. And there's certain things we can get from the interaction of these three financial statements that help us tell a little more about the company as well. Okay, so first off with the income statement, we have revenue, money that comes in the door for things we do, minus our cost of sales. Up until now, you may be familiar with cost of goods sold. We'll talk a bit more about that in a minute. It's going to equal our gross profit, and most financial considerations and conversations have something to do with gross profit when we start looking at a company. Minus our operating expenses, our overhead, gives us our earnings before interest and taxes, also known as EBIT, also known as operating profit. Minus the interest equals the earnings before taxes, and we take out the income taxes and we have earnings after taxes, also known as net profit, also known as net income after taxes. Now, apologies for all these things known as. Unfortunately, in different countries and different tax situations, or whether we're talking about publicly traded companies, privately traded companies, we have all these things that float back and forth. Different analysts use different words. Earnings after taxes and net profit are the most common. Okay, net income after taxes. I'm at the bottom line here. These are all the same thing. Mostly in this course, we'll talk about net profit because that's what we're familiar with. Notice, however, that net profit is after everything's taken out. A lot of you think that profit is just all the money you get in the door, which is not the case. I must make this distinction early on. These are the different levels of revenue and cost of sales and gross profit, operating profit, and all these fun things in net profit that you're going to be dealing with throughout the course. So you got to make sure you got these things straight right off the bat. Okay, now when we talk about things like net sales or net revenue, what we have is our revenue or our sales minus returns and discounts. Okay, so some companies will actually take very fine details on what they have as far as what they sell and how much they discount it. Typically, most of the time when we're talking about the average company, you're going to have your sales minus any returns. So if somebody returns something because it's damaged or old or whatever the case may be, they'll track that because it might be important if you're selling stale inventory or damaged inventory or whatever the case may be. Discounts not so much, and some companies and some systems don't track either. I'm just making aware that it exists. Okay, and most formal income statements, they'll show this breakdown on them. They'll just say net revenue or net sales or something like that at the very top. Okay, next we'll have a look at cost of sales. If we're dealing with a retail or a factory manufacturing type of situation, we have some beginning inventory. We add in the inventory that we purchase, commonly called net purchases. So things we buy and keep minus any discounts. We just want the actual cash value of what we buy, plus the freight in, plus direct labor and wages. The idea is the amount of money it costs us to get the stuff on the floor, put together, and ready to sell. Okay, so that's the cost of the goods available for sale. Minus the ending inventory. Okay, if we got stuff left over at the end of the period, the end of the year, that sort of thing, we didn't sell it. Okay, we didn't sell it, so it's not really sold. It's not the cost of the things we sold. Because we have the ending inventory, then we take it out, and that will give us the cost of the sales or the cost of the goods that we sold. Okay, this is a little bit important. It's something we tend to stumble over. Not going to cover too much in this course other than right here. You're expected to know this. This is something already covered, so just a quick review. Okay, again, cost of goods sold is usually used for companies that make things or buy and sell things. But more and more we have businesses that in Canada especially are a service economy. So we have a cost of sales. I'm going to use cost of sales in this course because it's more applicable to every company rather than just service companies. And it works for retail and manufacturing. So we're going to use cost of sales. Now, if I put that in terms of the income statement, we have our net sales minus our cost of goods. Almost did again. Minus our cost of sales equals gross profit. Similar idea, only just condensed into one line. Now, in our cost of sales, we could have goods that we bought and sold. We could have freight in, and we could have labor that we use to build something or put it together. And also, because if we're looking at service businesses, we could also have labor in terms of service. So if we got somebody out carpet cleaning, our cost of sales will be the amount we paid the person to do the actual carpet cleaning. Okay, so that's where cost of sales comes in terms of expense. Now remember, behind the word cost of goods sold and cost of sales is the word expense. These are expenses. We use them so often that we kind of assume that, but a lot of people in business kind of gloss over the fact that these are expenses, the money out the door that reduce our profits. Okay, so the cost of sales and cost of goods sold are expenses. All right. The variable expenses, we'll talk a little bit more about that down the road, but variable expenses, as you may recall, are expenses that go up and down when the sales go up and down. Okay, this is very important. They're directly linked. Your insurance or something like that might go up during the course of the year, but it's not a variable expense. Yes, it changes, but it doesn't change because of the sales you do. It changes because of the fact that insurance companies want more money. It has nothing to do with how much you're selling most of the time. Okay, sales commissions and delivery expenses, which i.e. getting the product to the service to the customer or selling the stuff to the customer, are not considered cost of sales in the true accounting sense. And this is where we get a bit of difference between business owners and accountants. Accountants say that's not. We're going to divide it, make a line. We're going to say commissions is part of marketing, delivery expense is part of operations, which is fine. But in a growing business, in your own business, in a small business, we tend to do something a little different with sales commissions and add it to the overhead. I'm not going to get into all the juggling with that in terms of actual what we do in numbers in this course, that's fine. But just be aware that some business owners will include sales commissions in terms of break-even calculations and that sort of thing. But as far as we're concerned at the moment, these are not included in cost of sales or cost of goods sold. Okay, so the idea of cost of goods sold is how much it costs you to put the product on the shelf or ready for sell, ready to be sold, or in the case of a service business, how much it's going to cost you or did cost you to actually do the service. So slightly different. Service businesses tend to blend that line a little bit, but in terms of accounting, sales commissions, delivery expenses are after cost of sales and cost of goods sold. That's it for Lecture 2.